Okay, thanks for having us. My name is Paul McConnell. I'm a principal analyst in Wood Mackenzie's Global Trends Group. If I can get this to work, I'm here to talk to you for about 20 minutes, giving you some high-level extracts from a piece of work we did earlier in the year called the Energy View to 2030. And then I'll hand over to my colleague James, who will give you a bit more in-depth detail around the North Sea and Denmark's role in that province. I'll start with a global summary, talk about some demand trends, and then finish off before I hand over to James about some macro trends and risks as well. But to begin with the global summary, I just want to touch on our economic view, just a couple of slides that explain that. Now, our view of the global economy this year is that it's recovering, albeit relatively slowly and in a piecemeal fashion. Global economic growth, we think in 2014 will hit about 2.4% for the year. But it's a bit of a mixed story. In the developed world, we see the world's largest economies, Japan, or the world's largest developed economies, Japan, the US, and Europe, growing together for the first time since 2010. But as the chart on the right shows, aggregate growth since 2008, since the financial crisis, is actually pretty weak in Japan and most of the European economies. Now, if I bring this chart up on the right-hand side, you can see that in more detail. This shows GDP growth indexed to just before the crisis at the end of 2007. And you can see that Japan and Europe, which I've represented here with the UK, are only really reaching pre-crisis levels of output around about now. Certainly a long way behind Germany, which is the powerhouse of Europe, and a long way behind the US, which is shown in red, which is economy is being supported by recovering consumption and also the energy industry, on the back of unconventional gas and tight oil. However, really on a global basis, it's really still the developing economies that are the most important, and China and India really are the top two. So these two economies together, by the end of next year, will have expanded in size by about 50% relative to where they were in 2008. It's important, though, not to lose sight of the fact that the US, though growth is relatively slow compared to the developing world, is still a very, very big economy, and China and the US together will be the two twin pillars of economic growth globally going forward. Now, just to focus a little bit on China before I begin to talk about the energy side of things. The chart here you see on the left shows our view of China's economy in dollar terms from 2000 to about 2018. The dark blue bars are the steps. This is how much China's adding on an annual basis to the size of its economy in dollars. Now, you've heard a lot of stories lately about China's economic growth slowing, and while that's certainly the case, it's important not to lose sight of the fact that China's economy now is really quite enormous. If I highlight here, you can see the last time economic growth in China was round about where it is now, about 7.5%. Around the beginning of the last decade, China was adding about $90 billion a year to its economy. Now, with growth rates the same, China's adding about $350 billion to its economy every year. To put that in context, that's about double the size of Singapore's economy every single year being added to China. Now, clearly, that has pretty big energy demand implications for that country and for the world as a whole. Now, as China's growth slows, the nature of that growth is also changing, and you can see that illustrated by the chart on the right, which has broken down GDP by sector. Traditionally, China's been a very investment-driven economy, but going forward, we expect to see that relationship change, and consumption will become a much bigger part of the story. This is driven by supportive policies within China, increasing wage growth, and expanding middle class, essentially demanding more goods and services. And this will change not only China's economy, but also the way it consumes energy. Now, this slide here, this shows our view of global energy demand in 2014. The units are million tons of oil equivalent, and this is primary energy demand. So this is everything from end-use demand for heating, cooking, transportation, as well as the energy which is used or needed to generate electricity. And there's a couple of things I want to highlight on this slide. The first is China is already the world's biggest energy consumer. It overtook the US around 2009 to take that #1 spot. And now in 2014, it's already 17% larger in terms of energy consumption than the whole of North America combined. That's the US, Canada, and Mexico put together. The second point I want to highlight is this other Asia-Pacific region. This is a group of countries which we've aggregated together. It includes some fast-growing places like Vietnam, Cambodia, Laos, but also the industrial powerhouses of Japan and South Korea. And that's demand in this part of the world is growing quickly and is threatening Europe to be the world's third largest energy consumer. Now, if I skip forward to 2030, you can see how this picture changes. China really is unequivocally the largest consumer of energy in 2030. We also see strong growth in India, the Middle East, other Asia-Pacific. But what you also note is that there's virtually no energy demand growth in Europe or North America. Now, there's two factors at work here. One is a story about limited economic growth in comparison with the developing world. But there's also a story here about energy efficiency. Of the two drivers, we think that in Europe, it's probably a story about weak economic growth, more so. In North America, energy efficiency is going to make more of a signature on our energy demand projections. And I'm thinking specifically about things like CAFE standards in the US, which are mandating increased fuel efficiency or fuel consumption figures for the passenger car fleet. Now, if I look at that 2030 number on a fuel-by-fuel basis, what I've done here is I've just taken the demand and I've divided it up to show you how this is satisfied. And it's immediately obvious the pale blue segment in China, that's coal. Coal will represent way more than half of China's energy demand, even in 2030. And you can see that it has a big signature in India, other Asia-Pacific, and it also retains a slice of the energy demand picture in Europe and North America as well. Now, this growth in the developing world is fundamentally a story about electrification. And I'll talk about that in more detail in a moment. But essentially, this will drive coal to become the world's most consumed fuel by about 2018. It will take that first position from oil. And we think it will retain that first position right the way out through to 2030. In terms of other fuels, if I just highlight here, what I'm bringing up now is the compound annual growth rates for each one of these fuels in each one of these regions. And you can see immediately that the red line, which represents renewables, is the largest in virtually every one of the regions of the world highlighted on this map. Now, we think overall renewables is by far the fastest growing energy source. It will average about 6% for the world between 2014 and 2030, but you can see from the chart, the slices, the wedges in the pie in 2030 are quite limited. So it's a story about fast growth, but from a very low base. And renewables will contribute only a small proportion of global energy supply in 2030. Now, the flip side, or at least the opposite of that, I think, is represented by oil. If you look at the navy segments and the navy bars, you can see that we've got very slow growth, in fact, negative growth in oil demand in North America and Europe, but slow growth even in the developing world, but from a relatively large base. The last point is gas is growing everywhere in the world, even in North America and Europe, where we see overall limited growth. We see gas taking a bigger market share from other fuels going forward, and again, growing in the developing world as well. So overall, it's a hydrocarbon world. We see that for the foreseeable future. Right, I'll just dig into a few demand trends, and I'll start with oil. So what I'm showing here on this chart is a relationship between wealth and demand for transport. So we've got GDP per capita along the x-axis at the bottom, and then transport demand in kilotons of oil per million people. So this is the demand for all kinds of transport fuel. Now, clearly, as people get wealthier, they consume more, and transport's no exception. But you can see in North America, it's way above anywhere else in the world, even when you account for wealth. So North Americans use a lot more transport per, for the size of their economy than anyone else. Now, the hollow squares on the chart are our forecasts, and you can see that that relationship is changing quite dramatically. It's coming down. This is a combination, as I mentioned, of things like CAFE standards, increasing fuel efficiency, but it's also a story about behavioral changes, people moving back into cities, and technology obviating the need for some journeys that may have had to be made, let's say, a generation ago. The opposite is true in the developing world. China and Asia Pacific, as people there are becoming wealthier, they're consuming more goods and services, there's more demand for personal transportation, and that slope will increase. But you can see that even in 2030, transport demand is way below where we are in Europe. Now, I don't have a chart on this slide which talks about industrial oil demand, but effectively what we're seeing is a reinforcement of the same trend. We see growth in industrial oil demand in the developing world, contraction in Europe, some expansion in North America, as I mentioned, this industrial reshoring gathers pace, but it's not enough to offset what's going on in the transport sector. And overall oil demand in the OECD is in decline, or already in decline, and will continue out that way to 2030. Growth is really concentrated in the developing world and specifically Asia Pacific. In terms of gas, gas is widely used. Residential fuel, it's used in industry, it's used even in a growing element in transport. But what I want to focus here is the power sector. I've plotted scatter plot. These are the top largest markets for gas into power worldwide, top 20. And I'm showing along the bottom axis the compound annual growth rate of overall electricity output. And along the y-axis, the vertical axis, it's compound annual growth rate of gas-fired output. So anything above the line, which is the one-to-one relationship, means that gas is growing more quickly than overall electricity output, and therefore gas is taking market share from other fuels in these markets. Now, clearly, there are some big markets there. China, we think gas-fired electricity is growing over 10% per annum between 2014 and 2030. India's there as well. But you'll also see North American markets, Canada, the US, Mexico, again, driven by unconventional gas. Gas is pushing coal out of the power sector in these regions. I also want to point out what's going on in Europe. Despite relatively low overall electricity demand growth, we still see an increasing signature of gas in places like the UK, Italy, Spain. And this is really a policy-driven measure, as European policy is stripping coal out of the energy mix for power generation in the coming years. We see gas effectively being forced back in to the power mix, despite the economics of gas not being that favorable. And this has important implications for Europe's energy security over the longer term. Now, again, I want to show another one of these scatter plots. This one is talking about electricity demand. Now, again, we see the same sort of relationship between increasing wealth as a country develops and consumption of electricity. Here I'm showing, instead of overall intensity for transport, I'm showing the amount of electricity needed to generate 1 unit of GDP. Developing countries tend to be a positive slope as they move away from the primary use of fuel and towards more electrification. You can see that trend has occurred very dramatically in China since 2000, as that country has adopted the role of the world's kind of manufacturing center. You can see that this rapid industrialization has driven up that metric quite markedly. Now, we will get to a peak there. As I mentioned, China's going to start to move into this consumption-driven phase of its growth. And you can see that at the top of the slope there. That's when consumption starts to become more of a driver of economic growth rather than investment. But the levels that it's at in terms of the amount of electricity it needs to generate 1 unit of GDP are such that even as it starts to decline, we're going to be a long way from where we are in this kind of post-industrialized nature of our economies in Europe and North America. China's going to be a long way above that even in 2030. Now, what this means, again, as I mentioned earlier on in terms of economic growth, China, slower, not lower. It's a scale issue. Even with slowing economic growth, with a high intensity of demand, we end up with very, very strong electricity demand growth. China's demand needs for electricity will reach about 12,000 terawatt-hours in 2030, according to this forecast. And that's going to be more than double what's needed in North America. So huge demand, and how is that satisfied? Well, China's going to be the driving force for virtually everything going forward. Renewables, it's already the world's biggest renewables market, and that position will only be cemented as we go forward. 420 gigawatts of combined renewables capacity in China in 2030, and that represents about a third of the world market. Nuclear, we see some countries adding marginal amounts of nuclear going forward. Some countries like Germany, Japan will be reducing their nuclear fleets, but China will be adding 150 gigawatts of additional capacity between now and 2030. This is the kind of rate that would rival the first nuclear boom we saw worldwide during the 1970s and 1980s. But despite all this addition of vast amounts of alternative capacity, we also see in our forecast, not shown here, almost 300 gigawatts of additional hydro capacity as well in China. We still have to have this signature for coal to satisfy this electricity demand growth. And in fact, China's power and industry sectors will account for about 64% of global coal demand growth going forward. So really, really big numbers, and this translates right through to our global outlook. Now, just a couple of slides left before I hand over to James. Macro trends and risks. Now, when we put all this together, these are a couple of the themes or three of the themes that we talked about in our energy view to 2030. And sadly, I don't have enough time to do them all justice, but I'll just touch on them now. I mentioned North America is a province of limited demand growth, but what we have seen there in the US especially is robust growth in oil and gas supply. And that's shown by this chart at the far left. So gas production in gray and oil production in blue. They're increasing rapidly. Oil production will begin to plateau post-2020. But in an environment of weak demand, what this means is that North America and the US particularly will become net energy exporters in quite the near future. So for North America as a whole, we think this transition will happen around 2018. For the US, we think it's going to happen by 2025. But note from the chart that the US will remain a net oil importer. This is oil products and crude, a net importer of oil for the foreseeable future. In Europe, we have a different set of challenges. So I mentioned gas pushing into the power sector, and this is helping European gas demand as a whole to grow even in this weak demand environment, and that's what I'm showing by these gray bars. At the same time, production is falling, as shown by the blue line, and what this means is an increased reliance on imports. Now, I'm not going to talk about everywhere Europe gets imported gas from. I just want to highlight the one that's front and center in everyone's minds, and that's Russia. So the blue line, the dark blue line, shows the proportion of Europe's gas demand, which is met by Russian imports. It's going to fall in the coming years as the LNG market starts to get a bit looser, and we see that gas coming out of the US. But even in 2030, we think that Russia will supply about 30% of European gas demand, and clearly that's a big risk with what's going on at the moment. Lastly, oil supply. I mentioned the US, and you can see that clearly here in navy blue. But the other thing I want to point out is Iraq. This is the green line about halfway down the chart. Our base case forecast at the moment shows Iraqi oil production going from about 2 million barrels a day to 8 million barrels a day in 2030. And not only is this the primary source of new supply growth for the Middle East as a whole, but it's also critical to ensure global oil supply and demand balances remain in a reasonable place over the long term. I've also highlighted here the production from the North Sea, and effectively, well, the UK, Norway, and Denmark, it's quite a different story. So yeah, it's a very, very different outlook to what we see in the Middle East and the US. I'll just end on this slide with some risks. I'm not going to go through all of these. I haven't got time. I could spend all day talking about risks. And I think as an analyst during my career, I don't remember a year which we've been faced with so many pretty big existential risks right across the spectrum. The hot ones for me, obviously, the Islamic State and the Middle East in general, right from the the Mediterranean right through to the Gulf. I think the whole region, as a producer, as a geopolitical hotspot, is clearly worth paying a lot of attention to right now. Similarly, Russia, Ukraine, hopefully a pragmatic solution can be found to the problems that we have on the eastern flank of Europe at the moment. On the demand side, I think China, as I've mentioned, the economy is slowing, and I think there is still the risk, quite a big risk, in fact, that China's economy could slow yet further, and that could make a big dent on our demand projections. But I think in the developing world there is upside as well. We see India as potentially, the new government is able to step over some of the challenges, some of the hurdles that have prevented economic growth from fulfilling its potential. In India, we could see an upside growth surprise there too. Longer term, I think the environment and energy efficiency could make a material impact on our demand outlooks. And I think on the supply side, we've all been surprised about what's happened in North America over the sort of last 5 to 10 years. And I'll just leave you with the thought that perhaps we could see an upside surprise to what's happening in the North Sea as well. With that, I'll hand over to James.
Thank you, Paul. So my name is James Webb. I'm one of Wood Mackenzie's regional analysts. In my role, I focus on the upstream issues and activities of Norway and Denmark. Now, this presentation is going to focus on the North Sea countries. And coming from Scotland, I'm quite pleased I only have to compare with one more. In fact, the last time I was in Copenhagen was the night of the referendum. So when Oil and Gas Denmark asked me to present a few regionally focused slides, I wondered how I could connect Paul's high-level analysis with the granular data and issues of the North Sea. Well, it didn't take me long to realize the connection. And that is the oil and gas sector is global. Every day, oil-producing nations like Denmark have to compete with one another to win investment into their own upstream sector. And that's particularly relevant as we talk today. We're in a strange upstream environment. The majors, who have been historically acquirers of production and upstream assets, have been net sellers since 2012. And they've sought to cut their capital expenditure while focusing on improving the financial returns of the investments they make. International oil companies, who have historically been fluctuating between buyers and sellers on a cyclical basis, have also been net sellers since 2012. But as you can see on the slide behind me, the global M&A markets in the first half of 2014 have remained buoyant, and two clear trends have emerged. The first is that a large proportion of M&A spend has been in North America. Majors and North American IOCs have been retrenching their investments back to the shale plays in the United States. And that's been replicated in where they've chosen to spend their investments. The second trend is that despite this, the M&A markets in the rest of the world have remained buoyant, and something is keeping them afloat. Well, that something is small cap companies, private equity, alternative financing, for example, something Wood Mackenzie glamorously calls others. And those others have contributed around 80% of global M&A spend in the first half of 2014. And this is particularly relevant in Europe, where two of the largest deals have fallen into this category. Marathon Oil's assets in Norway were purchased by small cap player Det Norske, and alternative financing vehicle Letter One purchased RWA Dea's company. So in this odd environment, the competition for investment is really difficult outside of North America. And that's not to mention the fact that Denmark has some noisy neighbors in the North Sea. So when a company chooses to allocate some capital to the North Sea, Denmark once again has a competition on its hands to win that investment for itself. On this chart, I've plotted the relative allocation of production, exploration, and development spend for the North Sea countries. That's Denmark, Norway, and the UK. This is a snapshot in time, but you can see we expect Denmark to contribute around 4% of all of the upstream activities in the North Sea in 2015. Now this must take or be the foundation of the strategy review that's going on in Denmark, noting where the upstream sector currently is and aiming to take a larger slice of that North Sea pie. Well, how does it achieve this? It's important for Denmark to be an attractive place to invest. At the foundation of the upstream sector is exploration. On this chart, I've noted the 3-year success rates on the left-hand side, as shown by the bars for the North Sea countries. And on the right-hand side, I've shown the average discovery per well, as shown by the triangles. At first glance, this appears a bit doom and gloom for Denmark. In almost 3-year period, no commercial discoveries have been made. In fact, the only discovery of note was Wintershall's Hibonite, albeit I believe this could be commercialized with time. But if we take a closer look at the data, it's not quite so bad. The average discovery per well in Denmark is greater than in the Netherlands or the UK. So what's driving this initial negative appearance? Well, that might have something to do with exploration activity. Over this period, 9 exploration wells were drilled in Denmark. That compares to 28 offshore in the Netherlands, 82 in the United Kingdom, and 99 in Norway. So if we consider exploration a numbers game, and I'm sure some of the geologists in the room won't thank me for saying that, but it's vital for Denmark that exploration activity is increased. But once you've made a discovery, the competition for investment doesn't end there. The financial benefits to companies for developing those resources must be attractive. On this chart, I've noted the average return, development size, percentage of those that are challenging, and the average capital expenditure per barrel for the North Sea countries. Again, this doesn't look so great for Denmark. The average return of 15% for future greenfield projects is lower than the 19% that could be achieved in Norway or the UK. And the average development size is also considerably smaller. Yet, like exploration, there is some hope. The average capital expenditure per barrel, that's the cost of developing those resources, is lower in Denmark than its North Sea neighbors, suggesting that smaller discoveries can be commercialized. But again, what's creating this negative image? Well, that might have something to do with the percentage of challenging developments, which is much higher than in the UK or Norway. In fact, this number of 70% could be higher, as I haven't included developments like Ada and Raven, which are difficult developments in their own right. But this problem is also faced by the UK. Wood Mackenzie expects over 50% of development spend to be on high pressure, high temperature, or heavy oil fields in the UK by the end of this decade. But the UK has sought to combat this, providing fiscal incentives for these projects to improve their returns and increase their probability of going ahead. But the competition for development spend, again, doesn't end there. Brownfield projects, which aim to maximize the oil recovery at existing fields, are also coming under intense scrutiny by companies. On the right-hand side, I've plotted Denmark's South Arna Phase 3 development against some of the most high-profile brownfield projects in Norway. The bubble size represents the remaining value at the project, plotted on a chart with return on the horizontal axis and value per barrel on the vertical axis. Initially, the bubble size for the South Arna Phase 3 project looks pretty large. However, I must caution that this is because much of the investment has already taken place, so the remaining value looks attractive. On a simple returns basis, it doesn't stack up quite so well. But the true reason for showing this chart and the illustration for it is that brownfield projects are facing the same financial challenges as new developments and greenfield projects. And in this environment, where every dollar spent is being scrutinized by E&P companies, I fully expect some of these projects will be scrapped or delayed. This directly goes against the aim of the governments of the North Sea to maximize the oil and gas recovery at existing fields. And I believe something must be done to better align those goals. I'd like to thank you for listening to our presentation today. I hope the slides will encourage debate amongst you. The Danish upstream sector has many challenges ahead, but I believe a collaborative effort can overcome them. Thank you.
Thank you, gentlemen. That was very insightful. I don't know whether it was encouraging, but at least exciting. Just one question before you'll be excused for a little while. I should also explain to the audience that there will be a chance for all of you to ask questions to these two gentlemen in particular a little later. Just one question before you leave. Mr. McConnell, the huge role of China on the demand side from now till eternity, how does that impact on the Danish part of the North Sea?
Good question. Good question.
Thank you.
No, I guess, I mean, China's, what I probably didn't make clear enough in that presentation, that China's not only a huge demand center, but it's also a huge net importer as well. It's a big net importer of energy. And I think, China's relationship as an importer will clearly, be pulling in resources from elsewhere in the world. I think, whether it becomes a sink for oil, beyond. Well, I mean, it could be driving up oil prices, which could be a good thing longer term. I think the direct relationships are probably relatively small.
Yeah.
But it's really its relationship to the world energy markets and what it does to pricing. I think is probably the key one.
James?
Yeah, I think the kind of underlying point there is that Denmark's self-sufficient in oil and gas as we speak, and it's only one of 2 European countries that are in that position, and many people don't realize that. So sustaining that for a longer period is going to be important, and the kind of global demand and where you can export those goods are going to be important in that.
Gentlemen, thank you very much for now. We'll have you back on here shortly. Thank you very much.
Thank you.
Thank you.